So in this problem we have a company that's selling computers, and they're selling computers to customers, and with that computer comes a 1-year warranty from the manufacturer, say Dell or whoever is manufacturing the computer has agreed that within 1 year they'll fix the computer if it breaks because of defect. Now these uh, department stores have tried to increase their net income, and one way of doing that, one clever way of doing that, is saying, look, the manufacturer of the computer is only going to offer a 1-year warranty. We'll extend that warranty, so if the computer breaks beyond that 1 year, for in this example it's 3 more years, we'll fix it, no questions asked. You come back to us, you bring the computer, we give you a new one, no questions asked. So the transaction that we're looking at in this problem, an extended warranty, is that the warranty is separable from the product. It's not with that embedded warranty from the manufacturer. So a contract now exists between the retailer and the end consumer. And so that's what we're trying to record when we're looking at this transaction, is what happened within this contract and how should the retailer correctly account for it. So we make the assumption here that the cashier was able to sell the extended warranty to one customer, and for $90 it says that we'll fix the computer for free after the warranty wears out from the manufacturer for 3 extra years. You only got to pay $90. Seems like a great deal, right? So what happens for the manufacturer? The first thing I want us to record is on the date that the customer walks through the cashier line, hands over cash, what happens? Fairly straightforward. I got some numbers here I'm going to delete. So on that January 1 of year 1, the cashier is handed $90, and they don't book revenue yet because they haven't earned it. Revenue recognition principle says you record the revenue when you exchange title of the good that you're selling, or you perform the service. We haven't performed the service, so at this point it's a liability. It's an unearned revenue. Notice no income statement impact as a result of this transaction. Cash is an asset, warranty liability is a liability. So we've kept our transaction to the balance sheet. There's no impact on net income. And that's what you do when you first buy the warranty. So the next thing I ask us as a part of this problem is, what happens at the end of that first year? So 1 year's gone by, right? So the whole 1 year has passed. Shouldn't we now record some of this revenue as being earned? And the answer is, at the end of the first year, you do nothing. There's no entry, because for that first year, remember, the manufacturer of the computer is covering the warranty. So we haven't earned any of our warranty revenue yet. Okay, so the next thing I say, what about at the end of that second year? At the end of the second year, this is a 3-year extended warranty, we now have provided a third of our contract, which is extended coverage of the product. So a third of this revenue, $30, becomes earned. So you can see here at the end, I've got 12/31 of year 2. We need to get that revenue into the right accounting period. So that warranty revenue is recorded, $30, a third of it, and this liability decreases by a third. So we still owe 2/3 of the contract, makes sense. We record a third of the revenue. And so this becomes easy for the next several years until we've recorded all of the earned warranty. So at the end of the next year, we repeat the same entry. So 12/31 of year 3, we earn another third of the warranty. Profit goes up by a third. Warranty liability goes down by a third. And you do the same thing at the end of year 4, at which point we now have earned $90 of revenue, and that liability has now been eliminated. We've adjusted for that accrual up front. So that's how we account for an extended warranty, at least the revenue portion of it. And in this example, I didn't have anything that said, the computer broke after 2 years, and so we had to fulfill our contractual agreement and replace it. And typically within these problems with an extended warranty, you'd have some sort of an estimate of a cost that you would expect to have to service over those 3 years. And the matching principle says that you would take that estimated cost, let's say it's $60, and you would appropriately record that cost against the revenue when it's earned. So if we expect to have to pay $60 at some point over this 3 years, we would record $20 of expense, a third of it, every period in which we would record some of the revenue. This problem didn't ask for that, but I just wanted you to know how it kind of works should you have that question burning in your mind. The last thing I want us to look at is what happens at the end of the first year. Remember, we're the retailer and we've just sold this warranty. What's my balance sheet look like as a result of this one transaction? So I've made this very ugly balance sheet. Of course, our cash would have increased by $100 because that's what we received as a result of offering the contract. But the entire 100, it's not 100, it should be 90. Sorry, not sure why I have 100. But the entire $90 would not be earned. It would sit on our balance sheet, and this is what's important as well, is you're able to distinguish the difference between a current and a long-term liability. This is not a current liability at this point in time, because at the end of, well, I take that back. At the end of year one, the manufacturer has covered their portion. So at the end of year one, we have a $90 obligation to cover the computer for the following 3 years. So 1/3 of that contract is within the next 1 year. So a third of this contract, a third of the liability should be current. 2/3 should not. 2/3 should be long term. So really I should have current liabilities here. Unearned warranty revenue. I'm going to earn a third of it. And then I would have some sort of a long-term liability. And that would be unearned warranty revenue for the remaining $60. Remember that classification is extremely important because creditors and investors look at liquidity and solvency of an organization based on how many current and long-term obligations exist. So hopefully this example and this problem has given you a better understanding of what a balance sheet looks like as a result of an extended warranty and how we appropriately record the revenue and all the transaction.